Hello and welcome. I'm Matthew from Rosie and Rosie, investment property specialist helping you invest in property with confidence. Today we're at Rise High Financial Solutions and we're chatting to mortgage and finance advisor Thuy Nguyen.
Hello.
Hi Thuy,
Hi.
and thanks for having us.
Pleasure to be here.
Thuy, it's the first Wednesday of the month, and yesterday, as they do every month except in January, the RBA announced the cash rate. And today I wanted to talk to you about what was announced and what the banks have done in response.
Sure.
So Thuy, what can you tell us about the recent history of the RBA's monetary policy decisions?
Okay, so yesterday they made a decision to put rates on hold at 1.5%, which is a record low, and it's been the rates have been unchanged, which is the cash rate, since actually the last 12 months, going back that far. And a large reason, I think, the reason for them to keep rates on hold is predominantly based on the state of the economy, also the state of the property market experiencing a bit of a slowdown, especially in the eastern seaboard.
Yeah.
And also tightening of credit has also been a reduction of loans being available to investors, so that also contributes to the slowdown. And
how have the major lenders responded to the unchanged cash rate, if at all?
They haven't done too much in terms of reducing rates, but they are increasing rates out of cycle to what the Reserve Bank has announced in the past. And that's largely due to their access to wholesale funding. So for them to borrow money, they borrow it from the international market, and with the US market and other countries are doing quite well, the cost for them has increased. And I think there's a little bit of cost for compliance have been factored in there as well. So they're increasing rates for their own internal purposes, and because of that, they're doing, I think, a little bit of what the RBA would do if they need to increase rates. The banks have already done it.
Yeah. So where do you see interest rates going over the next 6 to 12 months?
I think it's going to largely be dependent on the property market and how the economy is going to react to all these changes that's coming through as a result of the slowdown in the property market around the eastern seaboard, the changes in credit availability, all of those factors, and of course the household living expenses is going to play a big factor. But I would be surprised if the Reserve Bank increases rates in the next 12 months. If anything, I think they'll hold rates and might even reduce it, but highly unlikely because we're already at a all-time low for the cash rate.
Yeah, and throw the election in there as well. There's a bit of uncertainty.
Yeah, being an election year, that's what a lot of investors are holding back on as well. Not knowing what some of the policies are going to be implemented causes a bit of concern from the investors that are holding back.
Now, the Big Four are not the only lenders in the market. Tell us, who else is on your radar offering competitive terms at the moment?
So now more than ever, I mean, we've got about 60 lenders on our panel and only 4 of the major ones. So you can have such a spectrum of options and choice by going through a broker to give you access to those lenders. And they're still very much open for business. They do comply with their obligations in responsible lending, as we all do. However, they are more flexible, and their book is more open, so they're still open for business. It's just nowadays, if you get a no from a bank, you really need to think about, well, I need another opinion. Because there are other banks, different policies. Those banks' policy may not suit your circumstance, and that's why you need to go beyond that and explore other options as well. So definitely still open for business. The news tends to put out a lot of bad news because essentially sometimes bad news sells news, but lending is still quite strong, even though there's a more, I guess, insight into living expenses and people's conduct. But with education over time, I think people will start to understand what the banks will be looking for, and then we'll go back to a more standard, high level of conduct and servicing. So there's a lot of positives, I guess, coming, but it may feel like a bit of pain in the meantime. Exactly.
Which leads us nicely into my next question, which is about the Royal Commission and its findings. Can you tell me what are some of the key points that you pulled out of that, and what are some of the implications that the recommendations are going to have if implemented?
So apart from a lot of the banking recommendations, I'm just going to focus on the broker side of things and the banking for a retail lending scenario. So there's been some recommendation about a customer fee payable fee model, which means that the client will need to pay the service fee to get a loan through a broker or a bank. Now, in some cases, that's going to be very hard, especially for the first home buyer. Essentially, those customers that need us the most will have to pay for that service. So, thankfully, since the Royal Commission announcement, the banks or the political parties have decided to take that off the table, because having a model where the consumer pays for that service really is putting the competition back. There won't be much competition at all, actually. It'll put the power back into the major banks, create a monopoly, and essentially rates will go up. So the political party can see that, and they've actually announced that they won't be doing a customer fee pay model. Other changes would be, there's lots of elements of changes, but I think out of all of this commission, I think the best outcome is that the consumer is going to really benefit from this. They're going to see a lot more transparency of service and still have competition and still have access to choice of lenders. And that's the most important thing that we need to make sure does not get deteriorated through the Royal Commission findings and recommendations.
Excellent. Now, further to this, we're hearing that changes to negative gearing and capital gains tax are being tabled. What are these proposals, and what are your thoughts on them?
So the two proposals you mentioned, there's a few others, but the two proposals here, negative gearing, capital gains, will impact a lot of investors. Capital gain, essentially at the moment, if you buy a property and you sell it within the first 12 months, then the difference between what you paid for the property and the profit that you've made by selling the property, it's 100% taxed. If you hold it for 12 months, then it's 50% tax, so you get a 50% concession. So what's been proposed is that concession of 50% gets dropped down to 25%. So if you're a property investor who likes to buy a property, renovate and then flip it within maybe the first 12 months or even after 12 months, you will be essentially paying 75% on the capital gain that you make. So that may not be feasible if you do your numbers, and I would think twice if I was an investor that like to do renovations and flip, because at the end of the day, is there enough profits for you to do something like that?
It'll take a certain number of buyers out of the market.
That's right.
That flipping model.
It could also mean they need to change their model. Instead of flipping, they might need to buy, renovate and hold. And that leads us on to negative gearing. The proposal is negative gearing is going to be restricted to only brand new properties and not existing properties. So if you are a current investor at the moment and you've already bought the property, that's going to be grandfathered through. That's the proposal. But if the date has been announced that from this date forward, all properties will apply to this new law, then those future properties will be impacted.
Similarly to how depreciation benefits have changed in the last 12 months.
That's right, and I can only think that these policies have been put into place to stimulate construction, but with depreciation being removed from existing properties the last 12 months, I don't see a huge influx of construction approvals happening as well. So it leads me to question whether this policy is going to make much of a difference. In fact, it will be a negative impact for a lot of investors.
Well, I think what we should have been able to see to demonstrate its effectiveness is an increase in the number of first home buyers entering the marketplace. Seeing, I guess, fewer investors at opens and at auctions because of the disincentive to invest should correlate with the number of first-time buyers entering the market.
Yeah, I think that a lot more work could be done to help the first-time buyers get into the market.
Yeah.
And the super scheme that the government announced really was complicated to execute and to implement. So I only saw maybe a handful of clients implementing that system.
So in consideration of everything that we've discussed, do you have any tips specifically for investors looking to get funding at the moment or refinance?
Absolutely. I alluded to this earlier. No is negotiable, and the days of you going to the bank and then the bank saying no to you and then you just go away, it's over.
Yeah.
You need to take proactive measures to seek further advice and options that are available to you. Because right now the broker market takes about 56% of all lending markets.
Yep.
So we take a big share of the market, and that's because through education, through I just guess word of mouth as well, a lot of people are coming to brokers to give them the choice.
Yep.
When one lender says no, another one might say yes, and purely on just policy.
Yep.
So one bank could accept no commission or 80% of your commission, and another bank might accept 100%, depending on what kind of industry you work in. So that could make a big difference. And that's why you shouldn't just accept no for an answer.
And loan products are changing all the time.
Correct.
So it becomes incredibly difficult for mums and dads to even compare products, loans with each other. So if you want to find the best deal, absolutely speak to your broker. Thank you
You're
very
welcome.
much for your time. That's all we've got time for today. But before we let you go, Thuy, can you tell us how people can follow or get in contact with you?
Sure. You can contact me directly through phone. My number is 0409 407 346, or you can go into our web page, which is www.risehigh.com.au. And on there you'll see our business, and you can select me, Thuy Nguyen, as a broker for you to contact, or for me to contact you back.
Great. I'll put those details in the link below as well. Thank you for having us back.
You're welcome. It's
And
a pleasure.
thank you for joining us too. We hope you found Thuy's insights to be useful. If you have any questions for Thuy, I know she'd be only too happy to hear from you. Similarly, if you have any questions, queries or feedback for us, please send them in, comment below, or email hello@rosieandrosie.com.au. We'd love to hear from you too. It's been a pleasure, but again, it's time for us to go. I'm Matthew from Rosie and Rosie, helping you invest in property with confidence.
Thank you.